Investing often feels like a journey up a mountain. We look at long-term charts, and they mostly go up and to the right. It seems simple enough, but anyone who has actually climbed a mountain knows the path is never a straight, smooth line. There are steep parts, flat plateaus, and sections where you have to scramble back down a bit to find a better route. The stock market works in the exact same way. These pauses, these moments of backtracking, are what we call corrections. They are a normal, natural, and entirely expected part of the journey. They are not a sign that the system is broken, but rather a sign that it is working as intended, letting off steam and recalibrating expectations. Think of it like breathing. No living thing can only inhale. It must also exhale. A market that only goes up without pause is an unhealthy one. It's a bubble waiting to pop. Corrections are the market's exhale. They are the moments when investors collectively take a breath, look around and ask, are these prices right? Have we gotten ahead of ourselves? This process of questioning and reassessment is vital. It's what keeps the market grounded, in its own chaotic way, to the reality of business performance and economic health. Without these breathers, the disconnect between price and value would grow so large that the eventual fall would be catastrophic. So instead of fearing them, we should see them for what they are. A feature, not a bug. The interesting thing is that these breathers come in two very different flavors. One is loud, fast, and gets all the headlines. It's the sudden drop that makes your stomach lurch. The other is quiet, slow, and almost invisible day to day. It's the long, boring stretch where nothing seems to happen. Both are called corrections, but they feel completely different and pose unique challenges to our patience and our financial plans. Understanding the distinction between a sharp fall in price and a long, stagnant march through time is one of the most underrated skills in managing your own money. It's the difference between preparing for a brief, intense storm and surviving a long, drawn-out drought. Our goal here is not to learn how to predict when these breathers will happen. That's a fool's errand. No one has ever been able to do that consistently. Instead, our goal is to understand their nature. We want to know what they look like, why they occur, and how they feel. By understanding the mechanics and, more importantly, the psychology behind both types of corrections, we can build a financial life that is resilient enough to withstand them. We can learn to see them not as threats to our wealth, but as the inevitable price of admission for the incredible long-term returns the market offers. It's about being prepared, not about being a prophet. A price correction is the one everyone knows about. It's defined quite simply as a drop of at least 10% from a recent peak in a stock, an index, or any other asset. This is the version of a market correction that dominates the news. Financial channels flash red banners across the screen. Headlines speak of billions wiped out, and your phone buzzes with alerts telling you the Dow Jones just had its worst day of the year. It's a very visible, very emotional event. It feels like a sudden, violent lurch on a roller coaster. One moment you're climbing, enjoying the view, and the next, you're plunging downwards with your stomach in your throat. Let's use a simple, non-market example. Imagine a popular new taco truck opens in your town. The lines are around the block. Everyone is talking about it. In the excitement, the owner doubles the price of a taco from $3 to $6. People still pay it for a while because of the hype. But eventually, a few people start thinking, wait, this is a great taco, but is it a $6 taco? Word gets around. The lines get shorter. The owner realizes they got too far ahead of themselves and drops the price back to $4. That sudden drop from $6 to $4 is a price correction. The underlying product, the taco, is still good, but the price had become detached from its fundamental value, and a quick, painful adjustment was needed to bring it back in line. This is precisely what happens in the stock market. A company might be doing well, but investor enthusiasm can push its stock price to levels that are no longer justified by its actual profits or future prospects. Maybe it's a tech company that promises to change the world, and investors get caught up in the story, ignoring the numbers. Then, a single piece of bad news can act as a trigger. A disappointing earnings report, a new competitor, or a change in interest rates. This trigger pops the bubble of enthusiasm, and the price falls sharply and quickly, often in a matter of days or weeks, until it reaches a level that investors feel is more reasonable. The drama is high, but the duration is often short. The key to understanding a price correction is that it's an adjustment of price, not necessarily of underlying value. In our taco example, the taco itself didn't get worse. It was just overpriced. Similarly, during a market price correction, good companies can see their stock prices fall simply because the entire market was too optimistic. The businesses are often just as healthy as they were before the drop. This is a critical distinction. The pain is real, as your account balance shrinks rapidly, but it's often a fast-moving storm that passes, leaving the landscape mostly intact for the recovery that follows. It's a reset of expectations, happening out in the open for all to see. Now we turn to the second, more subtle type of market breather, the time correction. This one doesn't get the screaming headlines. There are no flashing red banners. A time correction is a long period where the market goes nowhere. It trades sideways, bouncing up and down within a narrow range, but ultimately ends up right back where it started, month after month, or even year after year. If a price correction is a sudden heart attack, a time correction is a chronic illness. It doesn't kill you quickly, but it slowly saps your energy, your enthusiasm, and your patience. It's the market equivalent of being stuck in traffic on the highway. You're burning fuel, but you're not making any progress. Imagine you bought a house in a small, stable town for $300,000. For the next 5 years, the local economy doesn't boom, but it doesn't bust either. People move in, people move out, and the price of your house just hovers. It might go up to $310,000 one year and down to $295,000 the next, but after 5 years, it's still worth about $300,000. You haven't lost money on paper, so it doesn't feel like a crisis. But you've lost 5 years of potential growth. That is a time correction. The asset's price didn't correct downwards, but time did the correcting for you. The fundamentals of the economy had to catch up to the price you paid 5 years earlier. This is the silent threat of a time correction in the stock market. An investor might look at their portfolio and feel a sense of relief. At least I'm not losing money, they might say. But this is a dangerous illusion. Not losing is not the same as winning, and in investing, standing still is often a form of going backward. While your investment portfolio is treading water, other forces are hard at work against you. Inflation is quietly eroding the purchasing power of your money. Every year that your investments fail to grow, the cash they represent can buy less and less. It's a loss that doesn't show up on your account statement. The psychological toll of a time correction is unique. A price correction is terrifying but quick. It forces you to act or, better yet, to stick to your plan despite the fear. A time correction, however, is a test of infinite patience. It's boring. It makes you question your entire strategy. Is this working? Am I in the wrong investments? Maybe I should just do something else. This slow grind can lead to more mistakes than a sharp drop, as investors get impatient and start chasing other, hotter assets, often at precisely the wrong time. It's a subtle trap, a slow wearing down of discipline that can be just as damaging as a market crash. Corrections don't just happen out of the blue. They are born from a combination of math and emotion, of valuation and psychology. At their core, they are a response to one thing: expectations getting ahead of reality. Markets are forward-looking. Investors are constantly trying to price in what will happen in the future, how much a company will earn, how the economy will grow. But we humans are not rational, calculating machines. We are story-driven creatures, susceptible to waves of optimism and pessimism. When the story is good, we can become overly optimistic, pushing prices to levels that already assume a perfect, flawless future. Overvaluation is the dry tinder that makes a correction possible. Think of a company's stock price as being tethered to its underlying business value by a long elastic band. The business value, its profits, its assets, its growth, moves relatively slowly and steadily. The stock price, however, can fly all over the place. When investors get excited, they stretch that elastic band to its limit, pushing the price far above the underlying value. At some point, the band is stretched too tight. It has to snap back. A correction is simply the process of that elastic band snapping back toward the anchor of fundamental value. What causes the snap? It's usually a specific trigger. This can be anything that shakes the collective confidence of investors. It could be a macroeconomic event, like a central bank unexpectedly raising interest rates, which makes borrowing more expensive and future profits less valuable. It could be a geopolitical event, like a war or a trade dispute, that introduces uncertainty into the global economy. Or it could be something much smaller, like a single influential company reporting weaker than expected earnings. This one piece of news can be the pin that pops the balloon of over-optimism, causing investors to reassess not just that one company, but the entire market. Ultimately, corrections are about the ebb and flow of human emotion, primarily fear and greed. Greed drives markets to dizzying heights, as investors chase returns and fear missing out on the next big thing. This pushes valuations into the danger zone. Then, when a trigger event occurs, the emotion flips. Fear takes over. Investors who were buying at any price a week ago are now selling at any price, desperate to avoid further losses. This cascade of selling is what creates the sharp drop of a price correction. The market is not a machine. It is a reflection of our collective hopes and fears. And corrections are the moments when fear temporarily wins the argument. It's crucial for an investor's peace of mind to understand the difference between a correction and its more fearsome cousin, the bear market. While both involve falling prices, they differ significantly in their depth, duration, and underlying cause. Getting them confused is like mistaking a bad thunderstorm for a Category 5 hurricane. Both are unpleasant, but one is a temporary inconvenience, while the other can fundamentally reshape the landscape. Knowing the difference helps you calibrate your response and avoid panicking unnecessarily. A correction is a test of your nerves. A bear market is a test of your entire financial foundation. The most straightforward distinction is mathematical. As we've discussed, a correction is generally defined as a market decline of 10% to 20% from a recent peak. A bear market, on the other hand, is a more severe and prolonged downturn, officially declared when the market falls by 20% or more. This 20% line is somewhat arbitrary, but it serves as a useful psychological marker. Crossing it suggests that the problems are deeper than simple over-enthusiasm and that a more fundamental reassessment of the economic outlook is underway. It signals a shift from a temporary dip to a potentially long and difficult period for investors. The duration is another key difference. Price corrections are typically short-lived. Historically, they last for a few weeks or a few months before the market finds its footing and resumes its upward trend. They are a sharp but relatively quick reset. Bear markets, however, settle in for a longer stay. They can last for many months or even years. They are not just a reaction to overvaluation, but are often accompanied by a broader economic recession, widespread job losses, and a fundamental decline in corporate profits. During a bear market, the underlying value of businesses is actually shrinking, not just the price investors are willing to pay for them. Here is a simple way to visualize the difference. Corrections generally mean a decline of 10% to 20% and are usually short, lasting weeks to months, often caused by market overenthusiasm or short-term fears. Bear markets, in contrast, involve a decline of 20% or more, last months to years, and are driven by deep economic problems or even recession. The psychology shifts from a buy-the-dip mentality to widespread pessimism and despair. Recovery from a correction is often fast and V-shaped, while recovery from a bear market tends to be slow, gradual, and honestly, pretty painful. This table helps clarify that while both are painful, they are not the same beast. A correction is a healthy and normal part of a continuing bull market, a pause that refreshes. A bear market is a sign that the bull market has ended and a new, more challenging economic cycle has begun. Recognizing which one you are in is less about predicting the future and more about assessing the present economic reality. Is this a brief panic, or are there fundamental cracks appearing in the economic foundation? The answer to that question dictates whether you should be preparing for a passing storm or a long winter. The danger of a price correction is obvious and immediate. Your net worth falls, and it feels terrible. The danger of a time correction is more subtle, like a slow poison. When your investments go sideways for years, two silent enemies are working relentlessly against you: inflation and debt. These forces don't care if the market is exciting or boring. They tick away in the background, and their impact is magnified tremendously during a period of stagnant growth. This is why a time correction, while less scary on the surface, can be more destructive to a long-term financial plan, especially for those who are not prepared. Inflation is the most persistent enemy. It is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. If your investment portfolio returns 0% for a year, and inflation is 3%, you have effectively lost 3% of your wealth. You have the same number of dollars, but those dollars buy less milk, less gas, and less housing than they did a year ago. During a bull market, this is less of a concern, as investment returns of 8%, 10%, or 15% easily outpace inflation. But during a time correction, when your returns are flat, inflation gets to eat away at your real wealth completely unopposed. It's a guaranteed loss in a sideways market. The problem becomes exponentially worse if you have debt, particularly if you've used leverage to invest. Leverage is borrowing money to buy assets, hoping that the returns on those assets will be greater than the interest on the loan. For example, an investor might borrow money at a 5% interest rate to buy stocks. In a market that's going up 15% a year, this is a brilliant strategy. You're making a 10% profit on someone else's money. But what happens during a time correction? Your stocks are returning 0%, but you still have to pay that 5% interest on your loan every single year. You are now guaranteed to lose money. Time is no longer your friend. It's your adversary, creating a bill that comes due every month while your assets do nothing to help you pay it. This is the quiet nightmare of a stagnant market. Each passing day, your real wealth is being eroded by inflation, and your nominal wealth is being drained by interest payments. A price correction is a quick, sharp pain, but a time correction is a slow bleed. It punishes impatience, but it also punishes anyone who is not on solid financial footing. It highlights the absolute necessity of keeping your debts manageable and your financial life simple. The get-rich-quick strategies that rely on heavy borrowing are the first to be wiped out when the market decides to take a long, extended nap. The most powerful defense is a plan that works even when the market doesn't. These concepts of price and time corrections are not just abstract theories. They play out constantly in the real world, affecting the most important assets in people's lives, their stocks and their homes. Looking at historical examples helps move this discussion from the theoretical to the practical. It shows us how these events feel and how they resolve, providing a blueprint for how we might navigate them ourselves. The dot-com bubble of the late 1990s in the Japanese housing market provide two classic contrasting case studies of a dramatic price correction and a devastatingly long time correction. The dot-com crash from 2000 to 2002 was a textbook price correction on a massive scale. For years, investor enthusiasm for anything related to the internet had reached a fever pitch. Companies with no profits and flimsy business plans were worth billions of dollars. The Nasdaq Composite Index, full of these tech stocks, soared. Then reality hit. The bubble burst in March 2000. It was a violent, brutal price correction. The Nasdaq fell by nearly 80% from its peak. Many companies went bankrupt. But here's the key. It was fast. The worst of the decline was over by late 2002. For those who held on to quality companies and avoided the speculative trash, the recovery was strong. The market reset itself and began a new upward climb. It was incredibly painful, but it was a crisis of price, and it was over relatively quickly. In stark contrast, consider the Japanese real estate and stock markets after their monumental bubble burst in 1990. At the peak, the land underneath the Imperial Palace in Tokyo was said to be worth more than all the real estate in California. The stock market, the Nikkei 225, was at an all-time high. When this bubble popped, it didn't just lead to a quick price correction. It ushered in one of the most famous time corrections in modern history, often called the lost decade, which actually stretched into 2 decades. The Nikkei index fell, and then it just stayed down. For over 30 years, it failed to reach its 1989 peak. An entire generation of investors saw their portfolios go nowhere. This Japanese example is the ultimate cautionary tale about time corrections. Imagine buying a basket of Japanese stocks in 1989. You wouldn't have just lost money in the initial crash. You would have lost decades of your life waiting for it to recover. Your money would have been stagnant while inflation ticked up and while markets in other parts of the world, like the United States, were creating immense wealth. This is the profound danger of a time correction. It doesn't just take your money, it takes your most valuable, non-renewable resource, time. It shows that sometimes the worst thing a market can do is not crash, but simply do nothing at all for a very, very long time. Knowing about corrections is one thing. Knowing what to do about them is another. The good news is that for the prepared long-term investor, corrections are not something to be feared. They are opportunities. They are the moments when assets go on sale, when the foolish and impatient are shaken out of the market, leaving bargains for those with the discipline to act. The key is not to try and time the market perfectly, but to have a simple, robust plan in place before the correction begins. This plan should be built around a few core time-tested principles that work in any market environment. First, and most importantly, is to automate your investing. The single best strategy for capitalizing on corrections is dollar-cost averaging. This simply means investing a fixed amount of money at regular intervals, say $500 on the 15th of every month, regardless of what the market is doing. When prices are high, your $500 buys fewer shares. When a price correction hits and prices fall, your same $500 automatically buys more shares. You don't have to be brave. You don't have to time the bottom. Your preset plan does the work for you, ensuring you are buying when assets are cheap. This removes emotion from the equation and turns a scary price drop into a welcome discount. Second, keep a cash watch list. This means having a list of high-quality companies or index funds that you would love to own if only they were a little bit cheaper. Do the research when the market is calm and rational. Then, keep some cash on the sidelines specifically for this purpose. When a price correction inevitably happens and the market is in a panic, you don't have to think. You just consult your list. Is that fantastic company you've admired for years now 20% cheaper? It might be time to deploy some of that cash. This strategy allows you to be greedy when others are fearful, but in a disciplined and premeditated way, rather than making impulsive decisions in the heat of the moment. Third, avoid the common traps. The biggest trap during a price correction is panic selling. Selling after a 15% drop just locks in your losses and turns a temporary paper decline into a permanent one. The biggest trap during a time correction is impatience. After a year of going nowhere, it's tempting to abandon your strategy and chase whatever is hot. This often leads to buying high and selling low. The antidote to both is to zoom out. Look at a 20-year chart of the stock market, not a 20-day chart. You will see that corrections are just small blips on a long, powerful upward trend. This perspective is the ultimate source of calm. Finally, stress test your financial life. The best way to profit from corrections is to ensure you can survive them without being forced to sell. This means having a healthy emergency fund, 3 to 6 months of living expenses in cash, and keeping your debt levels low. If you lose your job during a market downturn, your emergency fund allows you to pay your bills without having to sell your stocks at the worst possible time. A solid financial foundation is what gives you the staying power to not just endure corrections, but to take advantage of the opportunities they present. It is the bedrock of a successful investing career. In the end, the journey of building wealth through investing is a masterclass in embracing imperfection. We want smooth, predictable returns. We want a straight line pointing up and to the right. But the world doesn't work that way. The market's path is messy, chaotic, and punctuated by periods of fear and boredom. Price corrections and time corrections are not flaws in the system, they are the system. They are the fees we pay for the remarkable compounding that markets deliver over the long run. The sooner we accept these fees as a normal cost of doing business, the better off we will be. The secret to navigating both types of corrections is not to have a better crystal ball, but to have a longer time horizon and a stronger stomach. It's about recognizing that the short-term noise of the market has very little to do with the long-term process of value creation. Businesses will continue to innovate, profits will continue to grow, and human ingenuity will continue to solve problems. This is the engine of market returns. Corrections are just the temporary moments when our collective confidence in that engine falters. For the investor who can look past the immediate noise, these moments of faltering confidence are always opportunities. So, what should a new investor take away from all this? It's simple. Expect corrections. They will happen, and they will happen more often than you think. Build a plan that does not require you to predict them. Automate your savings through dollar-cost averaging. Keep your debts low and your emergency fund full. When a price correction comes, see it as a sale. When a time correction comes, see it as a test of your patience and use the time to let your dividends reinvest and your regular contributions accumulate more shares at flat prices. Don't let the drama of the first or the boredom of the second knock you off your course. Ultimately, your behavior is the only thing you can truly control, and it is the single greatest determinant of your investment returns. The market will do what it will do. It will thrill you with spectacular gains, it will terrify you with sudden drops, and it will bore you with long stretches of nothing. Your job is to remain constant through it all. Your job is to accept that the price of admission to the greatest wealth creation machine in history is dealing with uncertainty and occasional discomfort. Embrace the messiness, stick to your plan, and let the magic of compounding do its work over the one asset you can't get back: time.